Hello, and thanks for joining Supervision in reviewing the latest changes to super just passed by the Australian Parliament. Please feel free to share it with people you think will benefit from understanding the changes, which have been touted as the biggest since 2007. Whilst the number of changes have been significant, the number of people affected by the changes will be small. So if you're watching this video thinking that super is less attractive, we can assure you that super still offers huge tax benefits as a retirement savings vehicle. The changes should not discourage you from working hard to accumulate retirement wealth in super. Before we go any further, Supervision is licensed for general advice only. The detail in this video is to provide viewers information only and is not a substitute for financial advice. We offer this presentation as a reference source created from Treasury fact sheets. Here is a list of topics included in this video. Let's go through the changes one by one. In this presentation, we will discuss the $1.6 million pension limit, changes to TRIS pensions, concessional and non-concessional contribution changes, important information about low income offsets, removal of the 10% self-employment rules, and other reforms. The first change is a cap on pension accounts valued at $1.6 million. As any income created by pension accounts is tax-free, this change is designed to limit the amount of tax-free income people with large super pensions can earn. If you currently have more than $1.6 million in your pension account, this change will affect you. Otherwise, your pension will not be affected and you don't have to do anything. If you are planning to get a large amount into super, which will raise your pension over $1.6 million, you may need to consult with your advisor or do your own calculations to determine if that is right for you. Just to repeat, when we talk about tax on pensions, we are talking about tax on income created from pensions, not on pension capital itself. On the 1st of July 2017, if your member pension account is valued at over $1.6 million, you'll be required to remove the amount over $1.6 million into accumulation phase. You can also choose to withdraw that amount out of super completely. $1.6 million in pension phase on the 1st of July 2017 will be considered as having taken up 100% of the pension cap. If you take up 100% of the cap, you will not be able to add any further capital to your pension in future years. If you start with an amount lower than 1.6 million, you'll be deemed to have a percentage of the pension cap as at the 1st of July 2017. So for example, a pension account valued at $1 million on the 1st of July is deemed to be 62.5% of the pension cap. This means that you will still have 37.5% of any future caps remaining to put money into your pension. Each year, the pension will be indexed to higher levels depending on the consumer price index, which is listed currently as $100,000 per year. So in the 2018-19 year, pension caps will rise to $1.7 million. As the cap increases, you will be able to add to your pension by the original percentage remaining in your cap. So as an example, 2018-19 financial year, the pension cap will rise to $1.7 million and you will be able to contribute 37.5% under this example into your future pension. The income that is derived from money in accumulation phase will be taxed at 15%. The following example shows the tax impact of the changes on a person who has a pension account valued at $2 million earning $100,000 of income per year. Currently, this is the tax situation of that person. You can see that the income generated by the pension is not taxed within the fund. So the $100,000 that is derived from the pension account is not taxed at 15%. Now we have a look at the same member earning the same amount under the new rules next year. You will see that the pension account value is reduced to 1.6 million or 100% of the cap, which leaves $400,000 in the accumulation account. We assume that the fund still earns 5% return on its investments on $1.6 million instead of $2 million, which turns out to be $80,000, which leaves $20,000 derived from the accumulation account. Tax on the pension income is still taxed at 0%, so nothing changes on that income. But because $20,000 is now deemed to be taxable, the fund will have a tax payable bill of $3,000, 15% times $20,000 of income. This model does not include any tax credits or tax savings that now can be used to offset taxable income. Any losses created in that financial year will be able to reduce capital gains income. So the overall tax bill may be even lower than the example here. So when we put the two side by side, it's easy to see that the overall tax effect is 3% on income of $100,000 per annum. As your accumulation account goes up in value and earns more income, the amount of tax in the fund will rise. A typical share portfolio will carry with it franking credits and other tax credits, which can help you to reduce the amount of tax down to zero. However, that is money that is currently coming back to you as a cash refund from the ATO. There are also some capital gains concessions for people that want to transfer specific assets back into accumulation phase as of the 1st of July 2017. If you want to explore this, please contact Supervision to discuss. So, what can you do if you are in this situation? You can choose to withdraw the excess as a lump sum pension payment and invest that lump sum in your personal name. You may need to go back to doing personal tax returns and paying marginal rates of tax on that income. The amount of tax will depend on the size of the amounts that you put into your personal name and how much income they will derive. Speak to Supervision if you're thinking of taking out the surplus, and we can help you do the tax sums with you. From the 1st of July 2017, income generated from a TRIS will no longer be eligible for tax-free status. In addition, treating income stream payments as lump sums under the tax-free low cap rate, which is currently $195,000, will be forbidden. If you are currently on a TRIS pension, you may want to consider, with the help of your advisor, whether or not you carry on with a TRIS, or if you transfer the pension into an account-based pension or ABP and continue to keep your SMSF income tax free. Now we move along to concessional contributions. From the 1st of July, the maximum amount that you can contribute concessionally into super without breaching the cap is $25,000 regardless of age. Even though the limit applies to all Australians, not many Australians will be affected by this change. The government's own figures suggest a maximum of 3.5% of the population will go over the contribution limit in future years. The people this will affect the most are those that are trying to get money into super in a hurry. Those people that are getting closer to retirement, or those that have incomes over $250,000 per annum. For everyone else, it'll be business as usual, trying to get as much money into super before retirement. Currently, those earning $300,000 per year pay additional tax on their concessional contributions to super. From the 1st of July 2017, that limit is being lowered to $250,000. So if you earn more than $250,000, your SG and salary sacrifice contributions will be taxed at 30% instead of 15%. Let's walk through an example of the additional tax a person earning $260,000 will have to pay. In this example, the person is earning $260,000 and has forgotten to reduce their salary sacrifice contributions to match the new cap. You'll notice on the right hand side in the 2017-18 year that the person is now considered a high income earner and is taxed at 30%. Secondly, a tax penalty has been imposed in the 2017 year because the annual limit has lowered, but salary sacrifice continued unchanged, meaning they have exceeded the new contribution cap by $5,000. Division 293 tax is unavoidable, but the person would have been able to reduce excess contributions tax by stopping salary sacrifice contributions. People that are already paying the highest marginal rate of tax will not suffer an overall increase in tax if they contribute money into super, but they will not save on tax either. It can be a legitimate strategy to pay excess contributions tax in certain circumstances. When you're doing your tax planning this year, for next year, please consider the reductions to the concessional limits. From the 1st of July, the value of non-concessional or after-tax contributions that can be made to super has been reduced from $180,000 to $100,000. This change has the potential to impact people trying to get more into super closer to retirement. The trend towards lower caps has continued with these changes. The good news is that bring forward rules are still allowed. The bring forward rule allows people to use 3 years of caps in one financial year as long as you haven't broken the caps in prior years. To make non-concessional contributions, you must also pass eligibility criteria based on member balance size. If your superannuation balance is under $1.6 million, then you will be able to make non-concessional contributions in that financial year. If you have $1.3 million or under in your superannuation account, then you'll be able to use 100% of the bring forward rules. If your balance is between 1.3 million and 1.6, you will be able to make non-concessional contributions on a sliding scale as displayed here. There are some special caps for people that have not used their non-concessional caps in previous years. The formula is relatively straightforward, however a little complex to explain in this video. Speak to your advisor or supervision if you want to find out more about the transitional rules. So here's what we have covered. Not much to get through now. From the 1st of July 2017, if your personal taxable income is under $37,000, you will receive a refund in your superannuation account on tax paid of up to $500. This means that low income earners will not pay any tax on their contributions. Men and women who work part-time will reap the biggest benefit of this reform. Women are statistically more likely to have lower super balances than men. This reform has been designed to address this problem. From the 1st of July, you will be able to make deductible contributions to super even if you previously did not meet the definition of being self-employed. That is, less than 10% of your income came from salary and wages. It is now possible to contribute money to super on top of SG and salary sacrifice contributions to reduce your personal incomes. Salary and wage earners will now be able to make additional contributions when they receive additional income and reduce their personal tax by the amount they contribute. This may advantage people with their own businesses who pay themselves wages but also take distributions or dividends from their business each year. If you are in this position, please don't hesitate to contact us. If your spouse earns less than $37,000 per year and you make a contribution to their superannuation account, the person making the contribution is able to claim a tax offset of $540. Now we move on to the other reforms as we round out the changes. The government will extend tax exemptions on earnings in retirement phase to innovative super products like deferred lifetime annuities. This move is to improve the level of choice and flexibility in pension investment products and drive innovation in that sector. Superannuation funds were able to claim tax deductions in cases where death benefits were paid to dependents. As payments of death benefits to dependents is tax-free, there's no need to give superannuations a deduction for a proportion of that payment. Hence, the rules have been scrapped. Superannuation funds will also have to conform with new administration standards as part of the changes. So that covers all of the major changes in superannuation. The people mostly affected by the changes are those with annual incomes over $250,000 and super balances over $1.6 million. The other people affected are those wanting to put more money into super but are left it too late to put it in, especially those getting closer to retirement. There is some recognition that low income earners need help to get money in, and a tax rate of 15% may not be a concessional rate for them as their personal tax rate is low already. So what action should you take after watching this video? With reductions to contribution limits, getting enough money into superannuation is going to get harder and harder. So contribute often and back it up with solid investments that provide both income and capital growth. Please see your advisor for help with your investments, and if you have any questions from a tax perspective, feel free to call us. Don't leave it too late to do something about your superannuation. Thanks very much for joining us and viewing our video. Please feel free to share it with your friends or colleagues. The supervision team is always very happy to meet with you to discuss the tax implications of these changes or any of your other taxation needs.